When the time comes and everybody's scrambling for those ounces, there's going to be a rude awakening.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Hi, my name is Shane Moran, and I'll be your host for this week's episode of Live from the Vault, the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. And we have exclusive access to experts and insiders, and we reveal information and insights that you simply won't find anywhere else. Now, this week, we have the one and only Andrew Maguire, precious metals expert and whistleblower in the house. And to help him pull back the curtain, we'll be joined by popular demand from you, our Live from the Vault community, by industry expert, the one and only Craig Hemke. That's right, Craig is in the house, and you're not going to want to miss this episode. You're not going to want to miss this conversation. And just before we get started here, please help us spread the word about this channel by hitting that like button, sharing this information. If you haven't already done so, subscribe, not now, but right now. And then click that black bell there if you want to be notified in real time as each episode goes live. Now, for our viewers and our newer community members who have not yet met Craig Hemke, let me tell you a little bit about him. Craig began his career in the financial services back in 1990, and he retired in 2008 to focus on family and entrepreneurial opportunities. Now, since 2010, he's been the editor and publisher of the TF Metals Report. And you can find that at tfmetalsreport.com. We're going to put a link right here below and in the description right there. So Craig's developed, again, an online community for the precious metals and investors. And on top of all of this, you know, Craig is a Live from the Vault community all-star favorite. And with that, let's head over to the UK and talking gold with the one and only Andrew Maguire and our special guest today, Mr. Craig Hemke. Over to you, Andy.
Hey, Craig, and this is definitely no effort for me. There's a good friend of mine sitting right there, brother from another mother, and I tell you, we've known each other a fair while now.
Dozen years?
Well, tell me how long. Goodness me, Craig.
It's always good to see you, Andy.
Yeah.
It's been too long since I've seen you in person, but we got all this COVID stuff behind us now. So hopefully we'll be sharing a cocktail before too long.
Oh, yeah. Yeah, actually this year. Definitely coming over to your part of the world this year. And talking about your part of the world, this is so interesting because it's nice. I obviously look at a lot of what you do and what stuff you write about, and you've brought a lot of information to people your side of the pond, globally. But your side of the pond, to my view, really needs some help understanding gold. Really needs some help. I mean, I guess Europe. I mean, Asia. I mean, everyone on this side of the pond really needs not much education about it. So I guess obviously we go any way you like on this, but by crikey, one of the things that really gets my attention is the banking crisis that claims to be over.
Yeah.
And of course, it had nothing to do with the Fed raising interest rates rapidly and not stress testing any of the banks. No, had nothing to do with that. What the hell's happening over there? To me, it doesn't look over.
Yeah, funny, Andy. We have had here in the U.S. the second, third, and fourth largest by assets banking failures in history in a 6-week period in March and April. The second, third, and fourth. The only largest one was Countrywide, which was back in whatever that was, the financial crisis of 2008. And yet everybody thinks that's just some isolated incident. We have, you may be familiar, and global listeners may have heard the term FDIC before when mentioned with the U.S. banks. That's what we call our Federal Deposit Insurance Corporation. It was invented back after the Great Depression. as like a government fund that all the banks pay into to ensure deposits. And it's, I mean, woefully undercapitalized. You know, it's like just a little bit of money for like one or two banks if they go under, so that then everybody gets made whole and operations can continue, that kind of, well, whatever. The FDIC puts out a report every quarter on the state of the banks that they watch. And they've got a thing called the problem bank list. That sounds like, that sounds very benign, doesn't it, Andy? These are our problem banks. Anyway, at the end of the fourth quarter, there were 4 banks on that list with a total of $10 billion in assets. At the end of the first quarter, there were 43 with $60 billion in assets. Now, this is primarily brought about by, the change in interest rates, which the Fed is, after all their transitory crap for 2 years, is now hiked rates at a pace they've never done before. So they don't really know what they're doing. They're just kind of flying by the seats of their pants thinking, well, we got to hike rates now. So all these banks are underwater, even with the accounting changes that came out after the great financial crisis. And that's just the kind of the tip of the iceberg. The other thing going on over here, Andy, that I would imagine is global too. Maybe you can address what, they discuss in the UK, but commercial real estate is a major looming problem here with vacancies and, businesses going out of business, businesses downsizing their office needs. And the primary issuer of credit to mortgage or to credit, or people that are out there trying to develop properties and stuff, are the local banks, the local and the regional banks. They carry something like $3 to $4 trillion worth of commercial mortgage debt. So there are a whole bunch of problems that are either still percolating or are bubbling just below the surface. And this notion, and it's really put forth by the financial media that has an interest in kind of keeping the plate spinning. This notion that everything's fine. Oh, don't worry. Oh, yeah, we got it all in control. The Fed's omnipotent. That Silicon Valley Bank thing, all that other stuff kind of came from nowhere back in March. I mean, those headlines could pop up again anytime, and I certainly will before too long.
I think you've just outlined something, because that was something that I was looking at. In fact, Kaplan came out, I think, just a week ago, a few days ago, and he was talking about the disparity between the too big to fail banks and the smaller mid-sized banks. And you're talking about the banks that built America. You're talking about the banks that the local farmer would go and say, he'd know the guy by first name, and they go, I need some this, that, the other for, I've got a new tractor, whatever it is, done, because it was word of mouth, handshake, back as it always used to be. You knew your client. You didn't need any of the other crap.
Right.
And suddenly, all of, this sudden race in interest rates has forced. So if you were getting like 1% or 1.5% at your regional bank in a deposit or less, and you can move your money into a money market fund and 5% plus, well, then what are you doing? You're draining that liquidity out of the banking system, forcing a potential bigger collapse as these dominoes start to fall. Where do you see this ending?
Well, it's driving a consolidation in the banking sector, like you said, and as I mentioned earlier, all of this commercial stuff is done at the local level. Like, it's a lot of handshake deals, that sort of thing, and it's driving the consolidation into, again, who bought the most recent round of banks, J.P. Morgan, and what is their primary business? Credit cards and proprietary trading, right? They're not really at the local level getting to know you, that sort of thing. And so you're getting this consolidation. What eventually it leads to is the introduction of the central bank digital currencies, which, for all of us that own physical metal or participate in Kinesis, I mean, we're all kind of, getting prepared for that sort of thing in the first place. You got to control your own sovereign, territory with your own physical sound money and access to it immediately. This war on cash has been building now for a couple of decades. And the ultimate weapon will be this central bank digital currency. Now, to me, Andy, it's going to be rolled out in a response to this crisis as it comes. You'll recall, and I would suppose a lot of people listening to us will recall the whole TARP. Remember the Troubled Asset Relief Program? Was that that's for? Whatever.
Yeah.
Anyway, I remember watching all that, during the financial crisis in 2008. And, there was one bank after another that was falling. And when they came for Goldman Sachs, that's when it got serious. And they ran up Bernanke and Paulson and who's a little guy, Geithner, put him before Congress. They were pleading, we got to have this money. Because in the U.S., that's how it works. I mean, the Fed can't just simply print money, at least they're not supposed to. All of that all of the money comes from the House, the House and the Senate, the legislature. They control the purse, as they call it. So they had to be authorized to do TARP so that then the Fed could bail everybody out. And that was a mess. And you've seen, and it took a couple of votes to get that through. You've seen recently, this debt ceiling theater that we have over here. So ultimately, the Fed, I believe, wants this central bank digital currency, at least to begin with, so that they can kind of play whack-a-mole with all these banks. So if it's, a $5 billion, First National Bank of Huntsville, whack, they can hit it, with $5 billion of ones and zeros and recapitalize it. If the next one is the First Community Bank of Missoula, Montana for $2 billion, whack, they can hit that one too. That obviously cheapens the currency by just, flooding it out there and filling these holes whenever they need to. But that then is the camel's nose under the tent. And from there, just pray we don't go down that draconian road that, we're all so worried about, where eventually, like China and other places, you got to have your social credit score to be able to spend your currency wherever you want it. In the end, it all augurs for what you and I have discussed, man, for as long as we've known each other, and the value of Kinesis. To get your own money, get it in sound money, traditional money outside of the banking system, and your own, for your own personal sovereignty. But I think that's where this is all headed, because so many of these crises are inevitable. And you're right to point out this banking thing is not going away. And the Fed just continues to exacerbate the crisis, mainly because it seems like they want to, or they just don't know any better. And neither of those are very good options.
No, I know what you're saying. And of course, thank you, for mentioning Kinesis. And it certainly is one of my passions, because that's something where it is a solution. It's a solution. And I think one of the things that worries me at this point is that, some of the stuff we're talking about is now, if the thinking about the Fed for a minute, and again, we've just done a thing on the Fed a little while ago. I cannot believe how many people actually believe the Fed is actually something to do with the federal government, not just this cabal of self-serving bankers who are literally self-serving, but people accept, and even I sometimes think, oh, the Fed, and I just forget. Hang on a minute, this is a bunch of and I should say bankers, but it did slip out. I don't know if I'm going to get that edited out, but never mind. But it is, and yet their whole self-servingness, and I think one of the things that amazes me and amazes people I talk to, how could the Fed get themselves into such a mess? And they think, well, you think, well, how can any government organization be that stupid? Well, when you realize that they're not a government and that they are self-serving and that they're not caring about the future of anything, if anything, they're actually quite happy to go down the road that you just discussed, where you're actually starting to affect the actual ability to take responsibility for yourselves by literally shutting down banking systems, forcing you into a situation which undoubtedly is WEF type of thinking. And so, it worries me, Fred. It worries me that the Fed is actually kind of down that road. But one of the things that really, really gives me hope, they're the only central bank out there left that is still short gold. I mean,
Yeah.
Basel III, first tier asset, every single central bank except the Fed is long physical gold and will be using gold revaluation accounts to get themselves out of the, I was going to use the word SIHIT. So basically, because that's happening, and we just kind of thought, well, the Fed is sitting there vulnerable to, and if you have a gold revaluation account and you are a European bank or you are another global central bank or a sovereign, and that you still happen to have some physical at part of this 8,133 tons of gold that's been swapped out, you're going to ask for that back. But you may not get it back, because if you're going to revalue, use your gold revaluation account, which is simply selling the gold and buying it back, and you've suddenly solved the problem. So, but in order to do that, you have to ask for your gold back. Well, the Fed's in no position. It's so rehypothecated. It's so clear. The Fed's in no position to actually buy back this gold at market.
Right.
So, what do you think? How is this going to play out in your view?
Well, we have missiles. That's about the one thing that the U.S. does have, right?
Craig, but that's exactly right.
You've touched on a lot of things, Andy. One, in the U.S., and really globally, but particularly bad in the U.S., people have a real bad recency bias. You know, they've never known a world where the dollar wasn't the reserve currency, where the U.S. wasn't one of at least two, superpowers that could do anything they want. And so you just naturally assume it's always going to be that way. Our financial education over here is horrible. You mentioned people thinking that the Federal Reserve is somehow part of the U.S. government. And in fact, you'll even hear, whether it's people on the street, people I know, or people in the media will say, the next time the Fed hikes rates, they'll say the Feds hiked rates today. The Feds, as if the government did it, right? But as you know, and as most people know, they have nothing to do with the actual government. Though Powell, when he'll give a speech, he'll have the flags behind him, like he's the president. Mm. They treat these people as if they are these omnipotent, demigods, when they're no more qualified to do their job than you and I would be. Most of them have never had a job outside of the Fed. Like they parade this goon, this Bullard from the St. Louis Fed, on CNBC and Bloomberg and the like, a couple times a week. 37 years that cat has worked for the Fed. Has never worked anyplace else. And so what these guys do, they are political, nonsense, and they kiss a little ass here and kiss a little ass there and get promoted up the channel, and all of a sudden you end up head of the whatever reserve bank. And all they do is read the research reports. They have an army of economists and statisticians that crank out all these reports based off of certain models where, in the past X number of times we've done this, the economy has responded that way, and the like. And that's where they're in a real jam this time because, there have been hiking cycles in the past, but never like this. They all fooled around for 2 years after printing $5 trillion in COVID, saying inflation was transitory, when you and I and anybody with, an objective thinking brain knew it wasn't transitory. And then they tried to blame it on, the supply chain disruptions. And all. No, it's too many dollars chasing too few goods. It's a traditional definition of inflation. Oh, but don't worry about it. It's going to go away. Don't worry. I mean, even Yellen, all of them played this game. Mm. And in doing so, heck, Andy, it was only 18 months ago that the official statement from the Fed was that they weren't going to be hiking rates until 2023. It was late 2021. No hikes until 2023. Now here they're trying to tell us that there are going to be no cuts. Who believes? Why would anybody believe them? They don't know what they're doing. They're just, like I said earlier, they're just kind of making it up as they go. And so they set off, because they get behind the curve with inflation, they set off on this course of hiking at a pace they've never done before. The yield on the U.S. 2-year note's gone from 0% to 5% in 15 months. Credit card interest, highest it's ever been. Mortgage rates have more than doubled. The ripples across the economy have been profound, but yet they've never done this before, so they don't know what they're doing. They don't, after 6 months of this, then we should expect, no, that doesn't apply here. And so they keep on hiking, even though they don't really know what the economic impacts are, just because, well, the latest jobs report, which is nothing but statistical guesses anyway, sure looks strong, so we better hike again. What's going to happen is the same thing that's happened in the past, is they have hiked too far. And then you know what they're going to do? Just like when they hiked too fast last year in response to waiting too long, they're going to cut really fast. And all this stuff about, well, we're not going to hike till 2023 is now we're not going to cut until 2024. They're going to be cutting rates in response to this collapsing U.S. economy by later this year and into next. Next year's also an election year, Andy, here in the U.S., presidential election. You think these political animals, creatures, whatever you want to call them, at the Fed, they like their job. They like their cushy speaking appearances. They like, to be able to retire and go to work for Citadel like all the other Fed goons, make a couple $1 million a year flying around their Gulfstreams and everything else. They don't want to lose their jobs. So by the beginning part of next year, you're going to get, Elizabeth Warren and Bernie Sanders and all these politicians. What is going on? How come you're keeping rates so high? The economy's in the tank. It's, cut. And as soon as that goes, as soon as we're recognized in that period again, that's when gold's going to break out. And that's when silver is going to break out. And, you and I have been talking about this all year long. It's kind of a game of getting wrong-footed, being kind of led out of your position deliberately by the banks the first 6 months of this year. It's very important that people understand the reality of the situation, reality of these banks trying to get you out of your position. Because if you sell, somebody's buying. And hold on for dear life, because the back half of this year and next year are going to be some really crazy times for the precious metals.
Yeah, and I think, Craig, we're talking here about wealth preservation more than anything. Right. I mean, what's the point of, if you've got a hole in the bottom of a bucket, why would you pour more stuff into it? First thing you need to do is plug that hole. And gold and silver is really 5,000 years says, hey, of back testing, and it's just not rocket science. That is actually that's going to be the base to build wealth preservation, because they can't touch. That's the one thing they can't touch. They cannot touch something that has already been created. It's had all the work, the energy, the toil that has gone into making that bar of gold. Has no counterparty risk, and every single time that we see an interest rate hike, or every month that goes by, it's going to take more dollars, more pounds, more euros to buy that simple bar of gold. And people think gold's going up in price. It hasn't gone up in price. It's just taking a hell of a lot more dollars to buy it, that same bloody ounce.
Yeah. And Andy, it's doing what it's supposed to do. It's always supposed to have been your boat through the storm to get you from this monetary regime to the next, your protection against all of this madness, and yet you look, and it's doing exactly what it should do. I mean, it finished the year last year at 1829. So it's up $150 year to date, 7 or 8%. Since the beginning of this century, it's annualized about 9.5 or 10%. So it's doing exactly what it should do, but everybody's like, oh, this is so terrible. Oh my. And why? Well, I think two things, silver and the mining shares, because gold's doing what it's supposed to do. All of my physical gold, that I own in all the different places around the world in all its different forms, I couldn't be happier with it. It's wonderful. What's frustrating to people and what makes people, give up is silver, which is the most heavily manipulated asset in the world, little tiny market, right? Mm-hmm. But also the mining shares, which people buy because, like silver, they want to make money. They want to make some fiat off it. Now, I'll admit, I think the fundamental picture for silver and a relative valuation versus gold, and the undervaluation then of gold, which makes silver look even more attractive, is a tremendous, let's call it fiat making opportunity, which is why I own it. You can look at the precious metal mining companies the same way. You're like, well, this is like a leverage. This is like some kind of call option or something on the gold price. But they have their own all of them have their own fundamental issues and need a rising price. And so if you're in this and you own precious metal, physical precious metal for the store of value, sound money, lifeboat in a storm. They're doing exactly what they should do. And these day-to-day fluctuations are really meaningless. But the problem is so many in our sector are also, and I myself included, trying to make some extra fiat at this so you can buy even more metal. And that's what makes them maddening in the day-to-day stuff. But man, I tell you, the value proposition of owning the precious metals based upon all that stuff we've discussed in the past, the rehypothecated and over leverage of every single ounce of gold. It's priced as if it's plentiful when it's not. What's plentiful is all these other garbage derivative forms of gold. That's what's plentiful. But when the time comes and everybody wants their actual gold, as you mentioned, all the stuff that the U.S. has given away, and forward sold and leased out and everything else, when the time comes and everybody's scrambling for those ounces, there's going to be a rude awakening, and price is going to be revalued multiples higher. And we're stuck kind of waiting for that, but I'm sure confident that day is coming.
And you're talking about this disparity between paper and physical, basically, is what we're kind of talking about here. And and I think you've done a lot of good work on this in the past. I know yourself. And I mean, what was the whole reason in 1974 for creating the COMEX? And in fact, even Congress. I forget who made the speech, but someone said, "Well, what we need to do is create this paper gold and create enough to actually control the price." Right. And by literally listing in 1974, after the Bretton Woods Agreement got shut down, and central banks kept buying and buying and buying. They still said, "Well, screw $38, screw $42. Hey, we'll go to the foreign exchange market and we'll continue to swap our dollars for gold. Thank you very much." And the drain never stopped. So they had to do something. And so for this last 50 years, since 1974, they've had this game to themselves where they were able to, as you say, what the hell, just create synthetic supply, keep adding it just at the right moment, just when the right number of speculators have gone, yeah, I've bought it for the right reason. But then counterintuitively, suddenly, bang, down it goes. Yeah. Because they can create unlimited amount of gold.
Correct.
But on the 1st of January of this year, spot gold, the over-the-counter markets, became Basel III compliant. First tier, it converted gold into a first-tier asset. So now you've got the COMEX that is non-compliant. You've got the over-the-counter market, which is now fully compliant and must be backed by physical gold. So now we've got the Fed sitting on a broken manipulation tool. And this is what I'm trying to tell people. Yeah. I know historically we all buy into this, Craig. We all say, oh, well, it's going to go down because open interest has gone, the short interest has gone. It's going to come back down. And it's almost self-fulfilling. But I think two things happened. Suddenly, you've got the speculator group, which could be 100% relied on to borrow gold from the house, literally wait. You're holding the book on them. You know exactly when to nail them. And you nail them at the right point when they can't take any more pain and rinse them out. But there's a group of speculators that worked out, hang on, it's a first-tier asset class. Alongside bonds, cash, hey, that's a good risk hedge. And so we've got a split in the speculator category, which is actually, and then you've got this backdoor called the exchange for physical. That is literally the ability for a central bank to prey on the COMEX, take the undeliverable casino chips called open interest, put them into the spot market and take delivery. So this is, I keep trying to tell people, the game has changed though. And we got to let it play out a bit, but it's changed. What do you think?
Yeah, and the other factor in all of this, because they're all excellent points, and that's speeding along the process. The other factor in all this is this de-dollarization movement that you and I have discussed literally for a decade as well. We may have discussed this the last time we visited, Andy, but To me, the central event of last year, 2022, the war in Ukraine, and you can come up with all these other headlines that are memorable. But the biggest event was the first weekend of March of 2022, about a week after the war started, when the U.S. did two things. They seized Russia's foreign-held foreign currency reserves, about $300 billion, froze them, seized them, stole them, however you want to put it, and also kicked them out of SWIFT. And that action right there took that wheel of de-dollarization and gave it a big spin forward. And now efforts, anybody can just follow the headlines. Look for this on a weekly basis. These efforts being made by these, they call them the BRIC countries, to come up with an alternative system. Now, they'll need some type of trading accounting unit, some type of currency for all the global trade that they're going to conduct. And that's very likely to include gold as a basket, to give it some stability. So as that comes on, not even with, the impact that has on the dollar and, the traditional markets that we deal with, just the fact that that's now, those are going to be physical claims on gold. And that's what it's going to take to finally readjust, reset whatever this system is, a drawdown of physical metal. Every person watching us that can take an ounce out of the system and stick it in their safe is doing their part in ending this. Because, the banks will continue to lever and continue to rehypothecate and continue to create futures contracts and forward contracts and all the other crap, all this, financialized stuff. They'll do it all the way up to the end. But it's only a bank run, a true bank run on physical metal that will break it. Now, it may come from other metals. I think we all should all be watching copper. Goldman says above ground copper may be extinct by this fall. And if copper runs out of, we run out of physical copper or nickel or something like that, what's to stop relatively educated people from going, well, wait a second, if copper is like this, then maybe gold is too. So it might come from other markets, but it could also come from this de-dollarization or just simple recognition that the metal's not there to take delivery. And that's what we're waiting for. Just one last thing. You mentioned getting to this point. And I always like to bring this up because I don't know how many people really know the history of all this. In that after World War II and making the dollar the reserve currency, the U.S. won the war, so we had all the gold. And the dollar was backed by gold. So people were able to use it and use it in confidence to rebuild their economies all around the world, Well, then as countries did that, they started to accumulate dollars. And there were some countries that said, well, that's nice, but we'd rather have the gold, thank you. And the U.S.'s gold reserves have been cut about by 2/3 by the time we went off the gold standard and closed the gold window after the London gold pool failed. And so now there just wasn't enough gold for all of the fiat money that was being created to fight wars and the social welfare systems and everything else. And so what they do, they finally came up with some level of alchemy and created these financial products, which are considered to be as good as gold, really, but they're not gold. And this gets back, and the reason I'm going here is because you mentioned this when we got started. The Americans that think the GLD, they call it, I want some gold. So they call up their stockbroker, and their stockbroker says, we'll put you in this GLD. You don't own jack, man. You don't own gold. You own maybe some short-term exposure to price. But if push comes to shove, that thing will just get shut down. You won't, and you can't get any metal out of there anyway. Only the banks can get metal out of there. Or they'll own, like Canadians. The Canadian banks will sell you a certificate for physical precious metal. And you'll walk out of there, a happy Canuck, drinking your Molson, carrying your Canadian bacon, going, hey, I own gold. No, you own a certificate, a piece of paper, that if you read the fine print says you can show up and in 90 days we'll get you some metal. Well, good luck with that. And so we in the West, on this side of the pond, we don't understand it. Canadians have a better understanding of it. I don't mean to ridicule. They understand it better than Americans do. They're a little more natural resource focused, but Americans is just all paper assets, and paper wealth. So if we can ever get them to understand what has really transpired and how this alchemy has taken place to convince the world that COMEX futures or forward contracts or unallocated metal in London or whatever, that's actual gold. We get people to realize that that's not actual gold, that there are maybe 100 people that think they own that same ounce. And whether that gets forced by a bank run or something to do with these BRIC nations, laying their hands on gold and revaluing it, well, that's going to create quite a conundrum. Positive for conundrum for us, all of us that own physical metal, we're going to benefit from that. But for those that don't, man, they're in for a rude awakening.
Yeah, and you just described the two illusions: the GLD illusion, where you think you own gold; the COMEX illusion, interchangeable, deliverable, interchangeable, and considered to be the product. And you remember the time when Bob Pisani on CNBC went flying in. They had to put a blindfold on him. We're going to go to the HSBC vault. Took him in the vault, and he said, took off their blindfolds. This is so secure. Look, this is GLD. Picks up a bar, and the serial number. Somebody bright picked up the serial number. Hang on a minute, that doesn't belong to GLD. And you remember our friend Ned Naylor Leyland had just been literally about 2 or 3 weeks or a little bit before that, somebody come in owning another ETF that was physically backed and said, why don't you use our ETF? And literally it was their bar. And it was nothing to do with HSBC. Yeah. So it kind of created this stink. And of course, it soon got calmed down, didn't it? But but essentially, it is an illusion, a complete illusion. And thanks for drawing attention to that, because in 2013, this is another thing I know you covered in detail. In 2013, 1st of April, ABN AMRO failed to deliver on a client, saying, no, you can't have the physical. You will settle you in paper. This was our client. Sent us the letter. We went public on it, literally put it out there. Suddenly there's all this race to get their physical. On the very next day or the day or two later, what happened was the Fed, the first tier banks were called into a meeting with, who was it? Treasury Secretary at the time? Paulson?
That was still during Obama. Was it Geithner? Was he still the Treasury Secretary?
Yeah, either one of those bankers, as we call them. Literally, what? 1 or 2 days later, $550. 2 years, April 13 to April 2015, $550.
Yep.
What a farce!
Yes.
The cracks in the physical market, because no one could deliver. They'd reached a point where they'd already run into a Brown's bottom type situation. Again, it took 2000 to 2013. Suddenly, we're now back in the same situation where they've run out of liquidity to play this game.
Right.
And Basel III is one of the things that's causing them a major, and this is why every central bank except the Fed, who is stuck holding the bag after, as you say, in March, what do? Came in and did the same thing again. Hammered, pounded, brought more and more paper gold in the situation. In the meantime, every other bank by November of 2022 had covered their shorts. Bank of International Settlements covered 500 tons. There it was, zero as we go and enter the new year. They're still reducing their positions. The only bits they hold short are borrowed for the Fed. But the Bank of International Settlements, if they've covered their swaps, leases, and they're exposed to an upside price revaluation, along with all the other banks, what the hell is the Fed doing here?
Yeah. And you're reminding me now, I remember writing something 7 or 8 years ago. I remember titling it "An Open Letter to the Good People of Switzerland." 'Cause I'm convinced the Swiss National Bank has sold out from under the Swiss people their whole 1,041 metric tons too. The Swiss think they've got this independence. They've got all this gold. Yeah, all right. Well, we'll find out one day if you do or not. But that's absolutely right. And so what's going to happen, Andy, getting back to the West and the U.S. and how we view things, the U.S. doesn't like to buy things on the cheap. India, China, price goes down. They're buying. U.S. price goes down. Oh, I don't want any of that, man. I just want the momentum. I want whatever's going up. So what if, God forbid, I'm right about where this is all headed by later this year? The economy is in the tank here in the U.S. The Fed has to actually start cutting, like you have to expect them to do, and price takes off and breaks out. They can't restrain it, and it breaks out above 2,100, and people start to buy, and people are all of a sudden wanting physical metal again, and all of a sudden there's momentum to the upside. Well, what are they going to do then? I mean, I know they'll just reset and they'll try to defend a certain level and get short and flush the specs and all that kind of stuff like they always have. But the point of all this is it doesn't matter. I mean, even under this system, price will go up, as you said, at least in terms of how many dollars it takes to buy an ounce of gold. I mean, you just go back to 2003, it was 300 and now it's, 2000. So it's not like a lost cause where, it's never going to go up because the banks control it. What it is it's financial protection. In the meantime, it's still going up like it's supposed to go. But then there's this value proposition once you get into the weeds and begin to understand how this pricing scheme works, where you understand that, again, it's priced as if the metal itself is plentiful and abundant. And it's not. Silver is as well. We know that, what the Silver Institute say, there's a 240 million ounce supply deficit last year. Silver also priced as if, oh God, there's silver. Hell, I can just walk out in my backyard. There's just chunks of silver laying around. Okay. No, what's abundant is the financialized derivative that's used to discover price. There's no restrictions on how many of those can be created. You and I have restrictions with position limits and margins and stuff like that. These big banks don't. And so with no restrictions, they can create as many as they want, as long as they can keep people from taking delivery and keep flushing them out so that they never have to make delivery. Then they can continue to play this game that we've watched now, for as long as we have. The very interesting thing will be, as we get now into the back half of this year and next, and price gets away from them, how will they respond? Will they play the same old games? That's why all this Basel III stuff that you discuss every week is so important. Will they be forced out of these games by some of these, these other central banks that are all accumulating metal and getting ready for the next global currency regime? All of these things combined should signal anyone listening to us to at least take some of your dollars or your pounds or your euros or whatever and get them out of your bank where you're holding them and convert them into precious metal. That's what these central banks are doing. They're taking their currency reserves and putting into gold. If they think it's a good idea, it's, maybe you should think it's a good idea too. Okay. And that's, in the end, that's the value of, have these discussions, talking about physical metal, talking about Kinesis as ways that you can own physical metal. And we've been talking about this for a long time, but it is more important by the year, by the month, even by the week at this point that we keep telling everybody so that they can prepare for it.
Yeah, I think you're right. And there's no excuse for not taking responsibility for oneself. Gold and silver provide you that. Now, obviously, I was speaking to Mark Faber about this about a week ago, and he quite rightly pointed out, yes, but Andrew, not everyone can afford to do this. Well, yes, but I understand that, but you could still actually use something like Kinesis. You certainly could,
right,
for everyday spending money. And you would then at least be using gold again. You'd be creating gold as money. You'd be part of the solution. So at least you'd be part of the solution. I think I think one of the things that we really do see here is the divergence between what happened in 2010 when the last IMF gold sale came in. That was the very last gold sale. And then by no coincidence, China in 2010 opened up its gold market. You remember the billboards, the size of houses out there, mainstream television, buy gold, citizens go and buy gold. the price never, ever dropped below that time, where that level where China said, go out and buy gold, ever. And now recently, 5 weeks ago, they opened it up to the next level of clients. Yeah. And they were not the middle class that could afford the bullion. These are the millions and millions of bank accounts were suddenly given access to physical gold and silver. You just swap your RMB, click. Now you earn some gold. And there's a reason for this. And it's like, so, bottom line, we see China's President Xi Jinping, whether you like him or not, it's irrelevant. He walks around with a copy of Sun Tzu, The Art of War, in his pocket. I would say I'd listen to him. When Biden falls over, what does a cartoon comic come out of his pocket? I don't understand, but it's certainly not, I would certainly rather take notice of the guy that's holding the art of war.
Yeah, probably a good idea. Right, exactly. And one last point that kind of came to mind while you were talking too. There's a lot of doom and gloom people that I see on Twitter. They're primarily technicians, these technical analysis guys that are chasing their waves and counting their Fibonacci levels and all that stuff. And that's all. Hey, if that's what you want to do, knock yourself out. But they all see gold and silver as just a dot on a screen. They don't know anything about how the bullion banks operate. They don't know anything about, how the bullion banks are the one that make the markets and the contracts and the COMEX, and therefore either issuing contracts to the specs or buying them back and covering shorts when the specs dump, all managing price around a target so they can fatten their bonus pools and make their proprietary trading profits and all that kind of stuff. What is lost by so many people that trade this stuff is there really is, though, a floor. You mentioned it. What got me thinking about it was when you mentioned China. Think of it as if you're a banker trading for, you name the bank, JP Morgan or Citi or whatever, and you're managing price of silver, which of course they don't do, right? Andy, there's no manipulation. There's guys in jail for doing it, but no, we don't have to, we're not worried about manipulate, whatever. Okay. If you follow the commitment of traders reports, we saw this several times late last year where price of silver in particular came down to a certain level, and all the way down, the speculators were selling and getting short, and the banks were actually getting long. Now, why were they getting long? Because below $18 or so, the silver producers can't get it out of the ground. They stop digging it out. And so there's actually a wise banker going, maybe we ought to be long here because we've got all these other obligations, and maybe we can take delivery of some and feed it over here and all that. So there becomes, I don't like to use the term physical floor to the digital price because that kind of conflates the two together like a basket of oranges and car parts or something. But what it does, though, is it does create a level from which price stops going down. And then the opposite that we've always railed against begins to happen, where the specs that are short start to get squeezed and flush the other way. And again, this happened 4 times in the fall of last year, where silver went down to 18 and then sprung higher. And so my point in telling everybody all this, and again, this is just the nuts and bolts, this is the kind of stuff that Andy and I would sit and talk about over a beer because we can understand each other. We can kind of talk this language. But I tell this to everybody just so that you're not scared off. I mean, when you see somebody on Twitter saying silver's going to like 14 or gold's going to $800.
Yeah.
It's not. Okay. There will not be any physical metal anywhere at 800. And the system is designed, the current system is designed really to prevent that from happening. Because all the way down, as speculators are selling and dumping, the banks will be buying, and then eventually they'll get, so it's not going to happen. Okay, so please don't get frightened when you see these dips, these wrong-footed things where you're getting frustrated. You're thinking, price is never going to go up. Don't fall into this hype that somehow there's something that's going to drive silver back to the single digits and gold back to the triple. It's just not going to happen. It's not going to happen. So again, follow Andy on these. You can you follow me on Twitter, whatever. We talk about this all the time. There are certain realities, as much as we don't like this pricing scheme, there are certain realities to it that if you really want to know how the precious metals are priced, you need to understand. And that will prevent you from getting too low and too depressed, when prices are down. All prevents you from getting too euphoric and excited when things are going up too. And all of those are pretty critical, especially at this very important time in history where we stand here and going into the back half of 2023.
Well, Craig, to finish on a light note, that beautiful YouTube episode that you created.
That was fun, wasn't it?
I mean, Craig, what you've just summed up, you could sum up by just taking that 5-minute, 3-minute video and just looking at that episode, at that short little clip there. Entertain yourself, have a good laugh, and realize you summed up the game right there in graphic form. Very easy to understand, and it's exactly the game you just talked about. So, and you know what? I mean, I think what you mentioned your Rose Bowl, that fits 100,000 people. What does it fit in? Something like that? Yeah. Okay, we've had nearly 9 Rose Bowls full of people that have watched that so far. I want people to make it up to 1 million. So that'll be 10. And you know what? That's a hell of a lot of people that you've touched. And thank you for that. And you've entertained people along the way. We've got to have a laugh about these things.
You guys did a great job with it. And anybody that hadn't seen it, what's funny is that was just one of these conversations. I was actually sitting in my father-in-law's office at his house when you recorded that. And it was just a rant. And what was it, about a month later, you sent it to me, you said, you got to see this. And you guys did a great job. And all it for people that haven't seen it, it's all about just the scam of these unallocated accounts that we mentioned earlier, and how you're told you own physical metal. Well, and then that there are no storage fees by having an unallocated account. No, wait a second. Let me connect those dots. I own the metal. Yes, you do. But I don't have to pay to store it. No, you don't. Well, then what am I storing? Well, you don't actually have the metal. I mean, come on, this isn't complicated, right? That's how these schemes work. And again, if you don't hold it, you don't own it, man. Andy, you and I have been preaching that for years. And remember the whole Andy's Army that we used to do at my site 10 years ago. If you could make some fiat profits trading or whatever, hey, fine. But take those profits and buy an ounce of gold or 2 ounces of gold or 20 ounces of silver, whatever, and take it off their hands. Because eventually the accumulated impact of that is going to be something that is desirable for all of us. In the meantime, hell, if they want to sell it down, smash it down $100 or whatever, okay. If somebody's actually willing to give you an ounce of gold for, $2,000 US, take them up on it. That's long-term picture. That's a pretty good deal. Same thing for silver. Someone's actually going to part with an ounce of silver for $25 US. Okay, sure. If that's the price you want, I'll give it to you. That's fine. Because when all the dust settles, once this whole thing finally blows up after 50 years, it's not going to be $2,000 and $25 silver that we're looking at.
Yeah, and the illusion is literally evaporating. And as you say, the people that take in this gold at $2,000 are seeing it. Central banks, sovereigns are looking at this and going, bring it on. Just let me have it, and are taking it. And it's on a one-way journey out. And that leverage, the 100-to-1 leverage that still exists probably around the COMEX, is actually each ounce, each ton, each kilo that's taken out is actually diluting. Leverage works in 2 ways, and is diluting the ability to actually keep this game going. So, Craig, thank you for all you do. I really do encourage people to land on your website. You provide so much good information there, and it should be a first stop for most people every day. And thank you for all you do. And you've been around a long time that I know of. And you're a warrior, man, and appreciate everything you do.
These lines on my face. Yes, I'm wearing it, buddy. Maybe you might look like a little bit of a worrier too there, my friend. But yeah, 12, 13 years of doing this certainly provides its wear and tear. But the site is still up and running and strong, and it's a diverse community. Look, if anything, people should join my site just to interact with people that they think like, that can help reinforce them that they're doing the right thing and not be scared off by some headline they see or something that some permabear says on Twitter. So yeah, please, tfmetalsreport.com. Man, I just don't know if it's only $15 a month, so it's not like it's a deal breaker, and I don't know of any other site like it. I encourage people to check us out.
I think a couple of Starbucks and you're there, isn't it? I mean, goodness me.
Crying out loud.
And we're going to put a link up as well to this, what we've just been talking about. Click on it, guys, get it up to 1 million, and then we'll do something else. But I want to also thank our Kinesis team. These are the best in the world. These guys are absolute geniuses. And believe it or not, these guys have won awards at Cannes, and they quietly produce stuff like that. They just do it like that. And we don't know how much work has gone into these things, but they pop up and they're absolutely global first class. So I want to thank them along the way too.
Great stuff, Andy. And again, I just, knowing you and knowing Tom for as long as I have, please keep doing what you're doing with Kinesis. It's just fantastic what you're doing, particularly in parts of the world where, they normally wouldn't have access to things like this. So it's a pleasure to promote Kinesis and tell everybody how great it is. Just a pleasure to be associated with you guys, and keep up the great work.
And the privilege is all ours too. And thank you so much. And look forward to the next visit.
You got it, my friend.
All right. Thank you, Andrew Maguire and Craig Hemke, for another fascinating discussion. And I want to remind everyone to look for the link right here below for the video and on YouTube, and you'll find it at the biggest gold and silver swindle of all time. It's on YouTube, about 870,000 hits. We want to get it to 1 million. So there you go. That was Craig Hemke. It's an awesome video. You got to see it, and you got to share it with everyone you know, because it really tells, the story of what's actually happening in these markets. And remember, buy physical and make sure it's 1-to-1, and understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. And that's all we have for you today on another, again, fascinating and awesome episode of Live from the Vault. Now, please help keep spreading the word about this channel. Make sure you hit that like button, share it, subscribe, and click on the bell if you want to be notified as each episode goes live. And with that, we'll see you right here next time on Live from the Vault. See you then.